What's up, guys? Okay, so we are going to be doing the rate hike decision today. Expectations are for 75 basis points. Be sure to hit that subscribe button, Nick, if you haven't already. Yeah, we got 40 minutes until the actual rate hike. Hit the notification bell if you haven't already. What's up, guys? All right, dollar index is at like 111, roughly break even. Market actually started breaking down a little bit after I left, so mostly a downward trend. Hey, what's up, guys? What's up, Abdullah? Hey, what's up, man? JD, Prit, Ivan, DS, John, Gamer, Darshawn, Arthur, 2, Travis, Usman. I don't think 100 basis points is going to happen, man. I think it's almost certain to be 75 basis points. The question really is, how is the market going to respond to that? Is the real question. You know, that's the true question here, is how does the market respond to that? The actual rate hike decision drops at 2 p.m. on the dot. But you can see the dollar index up there. What's up, Jude? Orkin. Yeah, it'll be fun today, man. We got about an hour. You'll be able to watch it right here. Name. By the time it's going to take you to interpret it, I'll have the data here for sure. I mean, here's how you find it. Okay, so I'll show you guys how to find it. I mean, you can try to find it before me. We can race if you want. That's okay, you know. But here, this is how you find it. Okay, so on the FOMC calendar on the FederalReserve.gov website, you go all the way down to November 1 through 2. And then once 2 p.m. on the dot hits, you'll be able to refresh this and get the equivalent of this right here, right? And you can just click HTML. If you scroll down, you're going to look at this last number right here. If it's 4, it's 75 basis points. If it's 4.25, then it's 100 basis points. If it's 3.75, it's 50 basis points. So it's 3 3/4 is 50, 4 is 75, 4 1/4 is 100. So that's how you interpret it. So you'll be able to read it here, but that's where they post it. And then we're going to be streaming the press conference live here as well. The dollar index is breaking down a little bit too. Where's the SPY going to be at the end of the day? We're also going to do a poll here. Bullish or bearish on today's FOMC rate hike decision and press conference. Bull or bear. And then today we'll put neutral in there to see if you guys, because if we do 75, that is on par with expectations. So technically that's neutral. You can vote on that poll right there. We're also going to do a Twitter poll as we always do. All right, guys. So again, we're going to do a Twitter poll as well. All right, guys. So again, we can do 50 basis points, 75 basis points, 100 basis points, and then something else. Go ahead and chat. Then we'll make this one on Twitter. What? 2 hours, 3 hours, 2 hours. Really, it's about an hour. And so that's okay. We'll just do it that way. All right, hit the like button while you're in here. We appreciate you all. There you go. We got that poll going live here if you haven't seen it. Again, you can vote on this poll here. You can also take part of our giveaway. There's a link on Twitter. Go to our profile. Why would it affect the markets if it's priced in already? Well, whether it's priced in already is arguable. You know, I mean, it doesn't necessarily have to be. It's not like It's not like we know A, how much they're going to raise rates, B, what the market's response is going to look like. You can never predict the market on a super short-term basis. As a for sure thing. You never know what way the market could head. Earnings, if they show us anything, especially in this time of high inflation pressures, it's that you don't really know how the market's going to react. A lot of companies had bad earnings and went up this earnings season. And so, you don't really know how we're going to respond. The big influential thing is going to be the actual press conference with Jerome Powell. Everybody's going to be analyzing his tone really closely to try to figure out if we can gauge what the next Fed meeting in December is going to look like, whether they're going to pivot to a more expanding monetary policy or whether they're going to stay like it is, doing aggressive rate hikes and contractive monetary policy. That's kind of what we're looking at right now. That's what everybody's going to analyze it to be. And so it's certainly one of the bigger events that happen in the stock market, So, so the meeting is at 2:30. The rate hike decision is at 2. And so we're going to cover both of them here as soon as they drop, really. Feeling bullish but not trading based on feels. Yeah, I got to wait. I'm not going to force it too hard right now in terms of trading because, frankly, you don't know how the market's going to respond. I'm going to wait until after the rate hike and press conference, and then we'll trade a specific direction if we can. But yeah. It's going to be really, really interesting to see how the market responds. It'll be interesting. We're also going to get ready to send a newsletter out. You want to get these newsletters, go to beginnertrading.net/members. It is free. Doesn't cost anything to become a member. You'll get newsletters sent out on all the major stock market events. Yeah, we got about 35 minutes, really. There's the member list if you want to join it. We're getting ready to send that letter out to all of our members now so they can catch the stream. We also have the dollar index breaking down, over the last 10 minutes, but mostly neutral. You can see the previous closing price here. The market itself has actually been pretty bearish today. You can see it holding under VWAP. But longer term, when you look at it, we're still green over the last 10 days or so. Slightly green, not much, pretty much break even. So it'll be interesting to see what we get from this. But yeah. Here's the SPY. Dollar index is choppy. All right, SPY still breaking down a little bit. Again, I'm not going to trade much. Patience, I think, right now especially is key. Also, do me a favor, hit the like button while you're here. Again, we are going to cover... All right, guys. So, yeah, let me know what you guys think. Looking at our poll so far here, let me go ahead and send this newsletter out. Sending it out now. But yeah, looking at our poll so far here, we don't really know what's going to happen. We're pretty split down the middle. Bull, bear, neutral, 17%. 51% are bearish, 32% are bullish. Out of about 300 votes in the last 6 minutes, Dollar index still breaking down. It's at 111.50s here. We got the SPY up to 382.17s. Looking at our Twitter poll here, we've got 120 plus votes, 130 plus votes, 59.1% think we're going to get 75 basis points. And I would probably agree with them. About 20% think 50 basis points out of about 130 votes in the last 5 minutes. And then about 19% think 100 basis points. I think that we're going to show 75. But I think that outside of that, we're going to get a big knee-jerk reaction. If it's 100, we're going to go down pretty fast. If it's 50, we're going to go up pretty quick. That's the only really predictions I can have for it. I have no idea what we're going to get. Might have no idea what I'm talking about. And make sure to make your own assessment. Trade responsibly. Yeah. Hey, what's up, Rage? That's correct. We don't really know crypto. Do you think that you're going to release CP earlier than the meeting? CPI, you mean? It's not CPI. This is rate hike. This is the Fed raises rates to curb inflation. The more aggressively they raise rates short term, we have more pain, and the less aggressively. So if we come in at like 50, then we're going to have probably a positive response. And they do so in order to curb inflation. And they do so aggressively because it's more beneficial for prices long term, but short term it causes pain. And so, it'll impact the stock market pretty heavily. Specifically, the rate hike decision, I'm sure, will at least make the market move some if it's 75 basis points. If it's anything outside that, it'll move the market in a more heavy way. And like I said, traders are going to be just listening to what Jerome Powell says during the press conference to try to gauge, what he's thinking for the next rate hike decision, which is going to be in mid to late December. And yeah, he could say anything, man. They have before. If he takes what's called a hawkish stance, then we're gonna get drops in the market probably. If he takes what's called dovish stance, then we're gonna have moves up in the market. But there also might be some looming inflationary fears, so it's something to pay attention to in that way as well. But yeah, guys, thank you to everybody joining us. We still got about 30 minutes before the actual rate hike is gonna be. And so dollar index short term is moving down, and there's usually an inverse correlation between the dollar index and the market in general, and as well as other investment classes, because the higher the dollar is, the less people are going to invest. The lesser the dollar is, the more people are going to want to put their money to work in other investment vehicles. So that's kind of what's going on. But the SPY dropping today. Dollar index is moving up a little bit after the opening bell. As a whole, we're red. But again, if you look at like a 20-day chart and you zoom out, we're pretty green from a 20-day chart. Not super green, but green enough. We're not red over the last 20 days. If you look at like a month-long chart, we can add that to see it. Here's a month-long chart. So here is the last month of trading. It won't let me zoom out anymore. So yeah, we're slightly green. Let's see. We started the month off. I'm just going to look at a daily chart. This will make it a lot easier. So September started here. So we're pretty red in terms of where we were in September. I'm trying to think of when the last rate hike decision was. I know we did 75 basis points as expected. Let me look at it. So the last Fed rate hike decision was mid-September, if I remember correctly, which would be 6 weeks ago. So let me see. All right, guys. So yeah, so the last conference was September 20th and 21st. And so if we look at that price action, it was here. We had this pretty big drop from, let me see, this opened up at 386. So up here, we dropped from about 386 down to, 4 days later at 365 after the last rate hike decision. So this big bear action, each one of these candlesticks represents a day. And you can see this big red candle right here is when the last rate hike decision was right here. So that's kind of what happened. So we'll see if it affects the market in the same negative light. Since, beginning to mid October, the market has been moving up some. We started off mid-October here, and we had a green month relative to September, which is historically the worst month for trading. And right now, again, we're up to 382s or so. And so we're green, but this meeting will impact a lot of different things. And so who knows if we'll actually stay that way or not. We got 25 minutes. Results drop in about 25 minutes. Yeah. My name is John. That's rough. VWAP. Sorry to hear that, man. Yeah, we'll see if we get wrecked, man. I don't know if the market's gonna crash or not. Yeah, I mean, there's a lot of volatility that happens once the actual rate hike decision is going to be announced. And again, if you want to see what it is, like you could, I'll try to get it as fast as we can. We usually get this data very quickly, but we will still look it up normally, like right at 2 p.m., just like you can see here under the November 1st and 2nd, which is today's rate hike decision. It's going to have the same thing. It's going to say statement, and we're going to see a HTML or PDF file, whatever you want to do. You can click HTML, you scroll down, you look at this number. If that number is 4, it's 75 basis points. If that number is 4.25 or 4.25 is what it would be, then the rate hike is 100 basis points. If it's 2.75, then the rate, or if it's 3.75 and it's 50 basis points, and 50 will make the market go up probably. 75 is neutral. It's what they're expecting, so who knows what it's going to cause. And 100 will probably make the market drop. So again, if you want this link, I can give it to you, but we'll try to get it fast. Get the link. I'm waiting for that little pump that happens moments before the data drops to short it. And good luck, man. That's kind of a risky move. Yeah. It'd be funny if the market rallied after hawkish JP. We've had some bad earnings that have gone up. A lot of companies had rough earnings that went up. So it's kind of one of those markets that you don't really know what we're going to get. We'll see. Is this a quarterly announcement? It's a 6-week announcement. Yeah. It's not quarterly. It's every 6 weeks. I mean, every month and a half. We'll stream the Powell speech here. You'll be able to watch it here as well. SPY at 382.40s. So market's been mostly red. Yeah, the actual press conference is at 2:30. So we'll get the rate hike decision, and then the press conference is at 2:30. And again, we'll stream it. All right, we're at 382.50s. Dollar index is at 111.43s. Oh, I forgot to change my name from Damon Targaryen. I did forget to change that, man. Here, let me change it. I was Damon Targaryen for Halloween. I forgot to change my name. I couldn't remember where I found it. Like, let me change my name with somewhere different. I can't remember. It must have been under brand or somewhere. Where did it let me change my name? I can't remember. Oh, wait. Yeah, there he goes. Okay. I'll have to change my name there. All right, guys, we got about 600 people here. We can just do it like that. That'll be easier. We'll see what we get. It's about to go down. It really is, man. We'll see what happens, Sledge. Let's make some money, people. Good luck. Hey, y'all be careful. These things can really influence markets, so just be careful taking any like big sizable positions ahead of this. because the market can turn against you very fast. I'll trade it maybe if we get a trend afterwards, but I usually refrain from trading ahead of it. I'm pretty flat on my swing trades as well. The only swing trade I'm holding is Ford, and it's got a small enough range, and I'm in with small enough size that it doesn't really matter too much. Even if it goes against me, we're still going to be fine. Dollar index dipping short term though. Look at the dollar index drop down to 111.40s. SPY at 382s, 383s. Yeah, the next half hour is going to be, it's really the next hour is going to be fun. Johnny, are you buying Disney? I've already gotten out of Disney. I wrote Disney up from 91.60s all the way to like 102 or something like that. But I already cut it. In hindsight, it would look like the bad move to cut it. I mean, it's not up too much more. It ended up dropping back down, but it went almost up to 109. And so I can't help but feel like I missed out on any gains, but making over 10% in, a month or two on that trade, it's justifiable, exiting, I think, at a certain point. Once you're up enough, it's not really a reasonable expectation to expect more. Expect it just to like continue in your direction forever. SPY up to 382.80s. We got 20 minutes before the actual rate hike decision, team. Hey, what's up, Sanket? What do you think of Meta right now? I think Meta is pretty extended on the downside, but I also think that it's probably a little bit of an overreaction short term. I mean, Meta still owns Instagram. I know they lost a ton of money in the metaverse and all that stuff, but they still own Instagram. They still own Facebook, which still, both of those combined, have hundreds of millions of daily active users, billions really, if we're looking at monthly users. And so in that regard, I think $90-something for Meta's short term is pretty cheap. I don't really trust the company long term though, because I understand that most social media brands in general they don't have the most longevity out of tech companies. Usually a newer and cooler one comes out within 10 years and they just don't last that long. Depends on how well they diversify though. That's why Mark's trying to get into the metaverse, is because he understands that Facebook isn't cool anymore, and because of that he needs to diversify into other things and retain young people, because young people are really what grow social media sites. So that's it'll be interesting to see what happens. I think we're probably kind of cheap down here. Meta was my only swing trade I lost on. I got into about 6 swing trades over the last month and a half. I bought Snapchat at like $7.80s or $8, 8 something, or low 8s, high 7s is where I scaled it at. We also bought Amazon at like 90, Google around 90, somewhere 91, maybe 92. I can't remember what it was. Made money on those 3. We made money on Disney, like we said. We're up in Ford right now. We're swing trading Ford. And then Meta, we bought it one day right after earnings, I think, and then sold it the next morning for like $100 loss. So that was the only losing swing trade we've had. So I'm probably biased against Meta at this point in time, but I think I still can't help think it's an overreaction right now. The rate's coming at 2 p.m. In 18 minutes. SPY ripping up right now. Dollar index is falling down though. Look at the SPY going up. Big move. Nah, I'm not worried about penny stocks right now like Mullen. All right, guys. SPY up to 383.20s. All right, guys. Remember, the rate hike decision here is going to be in 17 minutes. In 17 minutes. Dollar index still breaking down. SPY tried to go green. You can see the previous closing price is way up here. So here's the previous close. Now, if the SPY moves up over it like this, then the market will technically be green on the day. So, like, say the Fed comes out with 75, and for whatever reason, the market interprets that as positive. This right here, like I said, might be a pretty big support or resistance level just because it's the level at which it goes from red to green, green to red. So that might be something to pay attention to on this chart. We're at 384.50s right now. So again, we'll see if we can keep this move up. Starting to break. Again, you can see the purple line right here, this volume weighted average price level. That's a relevant level to watch as well. Short-term trend identifier, I think is going to be less relevant. Maybe you could look for something to pull back here and then bounce and then start moving up there eventually to test these levels up here. That's possible. We'll see. Again, I have no idea what we'll really do. This is just all guessing, complete guessing. So not an expert, don't sue me. Will the Fed pivot to a more expanding monetary policy? I don't know. They could. Again, a lot of people have a lot of different opinions on that. Some people think it's good if they do. It will obviously cause short-term gains in the market if they pivot to a expanding monetary policy, unless it causes inflationary problems more. The question is whether these aggressive rate hikes have done enough to warrant that, and I'm not sure if we have. We'll have to wait. Hey, thank you, Sandcat. I appreciate it, man. What do you think will be the interest rate hike? I have no idea. My guess is 75. I think anything outside of 75 will be a shock to the system, and we'll get a big knee-jerk reaction from it. Now, again, to what level, we don't know. I think it's unlikely that we are outside of 75, but I mean, it's possible. Crazier things have happened. So we'll see. I really don't know. It's very difficult to predict exactly what the Fed's going to do unless you have insider information, which we're not supposed to have, and I don't really know either. So we'll see. I can only be cautiously optimistic and hope for maybe 50. I kind of hope that happens. If that happens, the market will probably, fly up just because it's so unexpected and less aggressive as a rate hike relative to 75. But I mean, there's also the other chance that the Fed's just trying to pull the Band-Aid off, so to speak, and they do 100 basis points. And if that's the case, then, we'll probably drop short term, but maybe we'll have longer term optimism for inflation problems. So that's kind of the nuance of the rate hike decision today. And we'll see, 75, nobody knows. 75 is neutral. It's on par with expected. Now it's conventionally like high, like comparing it to conventional standards of inflation, conventional standards of rate hikes, but currently it's what's expected. And so a lot of the times the directional reaction that we're going to get from stocks is all relative to what's expected. So again, 100 basis points will drop probably, and 50 basis points or lower, which is unlikely, will go up. I don't know about long term. Again, there's a lot of arguments being had about whether the Fed should pivot and stop being so aggressive in their rate hikes. A lot of people think they should. I think the best way to determine whether we should is look around at your prices in your area. Are prices going down in your area? What's gas look like? Those are all good gauges on inflation. Core inflation. Last time I believe the inflation was at 8.2%. We were a little bit higher, or maybe 8.3. I think we expected 8.2 when we showed up as 8.3 last time. In my area, gas prices are, let me see. National gas prices today are $3.75 a gallon, which is not really bad. All right, guys. SPY continued to move up, holding over VWAP here. Again, we are moving up. SPY's at 383s. All right, guys. SPY still moving up. We're at 383.60s. All right, guys. SPY starting to head up. Dollar index still falling down here. We got about 11 minutes here, team. 11 minutes. We don't know, guys. Everybody asking me here today, listen, I want you guys to really understand this. What effect will 75 basis points have? Nobody knows. You know, there's two arguments you could have here. One of them is that, are we baked into 75 basis points? Probably to a certain degree. I'm sure we are already loaded up into 75 basis points because that's mostly what's expected. Now, at the same time, though, you know, usually it's still going to cause a reaction of some sort. But to what degree, we're not sure. Again, a large majority of people, I've run a number of different polls, and just outside of my polls in general, just broader market polls from larger, you know, media companies are doing a lot of big polls, and most people are expecting 75. Most analysts in the stock market and the futures market are expecting 75. Most economic analysts are expecting 75. And so, again, anything outside of that, right now, the only thing we can speculate is that we'll have a neutral reaction. We'll probably range big if it's 75, but which way we'll head, I'm not sure. But again, all we can really say is that a large majority of people think we're going to do 75 basis points. I mean, it's not really an idea. I don't know how the market's going to react. Last time we dropped, last time we dropped for 3 or 4 days pretty heavily after the rate hike. But again, it wasn't the reason we dropped last time was not from the rate hike decision itself. And I want you guys to understand that the reason we dropped during the last Fed meeting was because of the Fed meeting itself and how Jerome Powell's tone was and what he was trying to do and what he said that the current economic state is. That is why we dropped after the last Fed meeting. It wasn't because of the actual rate hike decision, because that was on par with expectations. Another thing that made us drop, since then, at least a little bit, is the inflation report, the CPI report that drops this month. I believe it's on the 13th. That's certainly one of the other reasons that the market fell. And so, it's going to depend on his tone during the actual press conference more so than the rate hike decision, as long as it's 75. Yeah, it is 1 p.m. Central. That's when it is, Jack. It's 2 p.m. Eastern Standard Time. We can look at the Bitcoin chart real quick. Here's Bitcoin. Bitcoin's pretty neutral on the day. It's probably awaiting this decision too. Bitcoin at 20.5K roughly. Again, it's pretty neutral. Not really much going on. Dollar index has been, kind of neutral on the day as well. Pull up a 15-day chart. Slight upward movement over the last 15 days or so. Or over the last 3 days. Last 15 days, we've had downward movement on the dollar. Again, the dollar under 110 would be great. We want the dollar to fall here if we want the market to go up. And we can also look at like this level here on the SPY, previous low from pre-market. If you look at this, this might be a bounce level leading into this. You can see we're right at that level now. So that might be interesting to watch. To see if we actually hold there or not. Again, guys, we got about 8 minutes, team. 8 minutes. Also, I'm going to put us in sub-only mode. All right, so I'm going to put us in sub-only mode. So if you want to chat, hit the subscribe button. Again, everything we do here is free. We don't charge a penny for any of our content. Like, what we believe here is that everything we drop is free, and we don't charge for content. We have sponsors and affiliates, of course, but we don't have any paywalls behind content. We're just trying to give people free stock market information. We cover all the major economic releases, earnings reports, all that stuff. We cover earnings, CPI, PPI, GDP, jobless claims, retail sales, the FOMC rate hike decisions, the Fed minutes in a couple weeks. We're going to cover that. We cover all the major stuff. So, hit the subscribe button, hit the notification bell. And we appreciate you all. The employment rate is already up 40,000 expected, so I think that's a warning. Yeah, I mean, again, right now we want numbers to drop. What was rough this morning, if that's what you're referencing, was the what was it? It was the sorry, I gotta find it. The ADP National Employment Report. It came in way higher than expected for ADP National Employment, way higher than expected, which is bad for inflation. Which is one of the reasons the market dropped so much since then, really, is because, it came in pretty negative. They expected 195. It came in at 239, which conventionally would be seen as positive, but because inflation's so high, the market reacted negatively to it. I think it came out right around here. And that's what sparked, the following drop for the rest of the day today, mostly. Hey, all good, Yowzer. Hey, thank you, Ledge. Gary, what's up, team? Joe, Jack is, I don't know what he thinks, man. The only stock my son, 8-year-old son, cares about is Roblox. He cares about Roblox, and I think now after I explained to him that Minecraft is owned by Microsoft, he cares about Microsoft. That's it. Again, dollar index has been falling down pretty drastically for the last 7-8 minutes here. So I think Russian GDP just dropped, came in at -5%. Previous was -4.1%. So Russian GDP did drop. According to Electric, there's no evidence that the Tesla Cybertruck is not on schedule. And so those could be influencing the market positively here. 75 is most probably. My son's 8. Yeah. 4 minutes, guys. 4 minutes. Y'all ready? Y'all be ready. It'll be fun, man. See what we get. Yeah, we're ready. We're going to look it up as soon as it comes out. Sometimes it's a little slow, but, we'll cover it as soon as it drops. We got a bunch of different sources up. Again, expectations are for 4%. 4%. And so got a lot of different places up. Expectations are for 4%. Again, when you look at the report, when you read the report, that's what you want to analyze. When you read the report, you look at how much they're raising rates. If they say 4%, that's 75 basis points. If they say 4.25, that is 100 basis points. If they say 3 3/4, then that is 50 basis points. Again, we already explained what the reaction will probably look like with each of those scenarios. But again, we're probably going to do 75, almost certainly. Your son sounds like the average trader on social media. Honestly, Jack guessed that. I asked Jack what he thought about Roblox because he plays Roblox. I said, "Hey man, what do you think Roblox is going to be in 5 years?" And he literally said, 40. He said it would be about half the price, is what he said. And this is when it was at 80. And if you look at Roblox now, I think he got incredibly lucky. But I'll still brag about it like he was right, because he was. But yeah, greatest stock pick ever. Dollar index starting to bounce up. You can see the SPY dipping down a little bit. Again, we got less than 3 minutes here, team. And so the actual rate hike decision, less than 3 minutes. Y'all be ready. Yeah, we're getting some little drops here ahead of it. Again, popping back up. Right now, we have less than 2 minutes, about a minute and a half before the actual rate hike decision. And then again, we're going to stream the press conference. We will stream the press conference. And again, we'll see what we get. Roblox at 44.20s. SPY moving up a little bit short term. I get about a minute left, 1 minute. I'm ready. I got all these different sources up, team, so y'all be ready as well. We'll see. I'm probably just going to look it up myself. I'll probably be able to figure it out myself before anything else, as soon as it reflects. All right, 1 minute, guys. Exactly 1 minute. Dollar index moving up a little bit. Be ready. Hit the sub button. Hit the notification bell. We'll see what we get. Again, 4% on par. So 4% would be 4% would be 75 basis points. 4 1/4 would be 100 basis points. 3 3/4 would be 50 basis points. SPY is sideways here. We got about 30 seconds left. 30 seconds. All right, 15 seconds. Ten seconds. About 5 seconds. All right, guys, here we go. SPY's consolidating, doji candle ahead of this, and there's the decision. Waiting for the numbers to come out. It's not reflecting yet. Market's going up though. It's 75 basis points. It's 75 basis points. Or no. Yeah. It's 75 basis points. It's 4%. It's 75 basis points. So this is on par with expectations. So again, by this, it'll probably be a neutral reaction. So 4%, 75 basis point rate hike is what it is. Market's flying up on it. Look at the market rip. 385s right now. Dollar index crashing down here. Again, on par with expectation. I guess they're interpreting as positive. So market's going up. Dollar index is falling. All right, we're at 385 right now. Market's flying up. I mean, this is good for my swing trades. Again, 75 basis point rate hike. Powell speaks in about 30 minutes. We'll cover it. We'll stream the whole thing live. Stick around. Market's flying up at 387s. Dollar index crashing down. Bitcoin, I'm sure, is flying up. Yeah, Bitcoin up to 20.7s. Again, dollar index is falling down drastically down to 110.90s. Market's up to 386. So a pretty positive reaction. A lot of volume rolling through. Yep. So, I mean, that's positive, I guess. Everything's going as it should for the Fed rate hike. Market's going up big. 387s here. Dollar index is falling down. The Fed vote in favor of decision was unanimous as well. Again, you can see the full statement in chat if you guys want to see it. Y'all, I'll copy the full statement here. Here's the full HTML page. It says, recent indicators point to the modest growth in spending and production. Job gains have been robust in recent months, and unemployment has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Russia's war against Ukraine is causing tremendous human and economic hardship. Didn't they say this last time? I'm getting deja vu here. The war and related events creating additional upward pressure on inflation and are weighing on global economic activity. The committee is highly attentive to inflation risk. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. In the support of these goals, the committee decided to raise the target range for the federal funds rate to 3 3/4 to 4%. The committee anticipates that ongoing increasing in the target range will be appropriate to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Market's going up from it. It's at 387s right now, 387s. Dollar index is just falling down dramatically, which is really interesting. And again, it kind of shows you guys, this is why it shows you that this is why you can't really take any bets ahead of time, because the last time this was announced, I don't know if the rate hike decision went up. Let me check. But I know we dropped for 4 days since it, and this time seems pretty positive. Let me look back. Let's look at a 180-day chart. All right, so the rate hike decision came out here. Last rate height was, let's go on full. Market is trying to consolidate at 387s, was right here. No, that wasn't it. That was CPI right there. So let's keep going. Here was the last rate hike decision. So we did pump up a little bit ahead of time. We were right around the same spot too. We were right around 383s. So ahead of this meeting, we're at in between like 385s and 388s. After the rate hike announced, we actually ripped up to 389s and then completely turned over the next 5 to 7 hours here. So again, we'll see if that happens now. It's 2 p.m. market time. The actual market hours close at 4 p.m., but we'll still have after hours to see how this is really going to impact everything. Dollar index is just dumping down hard, but it definitely looks like a more positive reaction than last time. Again, a lot of this is going to depend on what Jerome Powell states during the press conference, so which we will stream. All right, guys. So again, SPY's at 387s here. Dollar index is still breaking down. So let's see if we hold support. But a very bullish response to this. Yeah, so Powell speaks in 25 minutes at 2:30. That'll influence everything as well. So again, we'll see what happens. Market's initially responding positive, though. We're up to 387s right now. All right, so again, let's watch 386.50. Fed raised it 75 basis points as expected, and as we all kind of told you guys we probably would. I think most people expected 75. Again, the real question is, what does Jay Powell state? If he comes out and he's like, hey, things are going as expected, we're getting to inflation to fall down. Hopefully he does, and that'll cause huge rips in markets. But, you never really know here. We'll see. Nice little green response here, though. Up to 387s right now. All right, we're starting to move up. We're at 387.50s. Again, 75 basis point rate hike is what they announced. I remember this exact situation happened last time. Yeah, I mean, last time we ended up dumping down pretty hard after the actual press conference. So again, it depends on if he pivots or not. A lot of people are expecting him to. If he pivots, he's going to be more, again, a pivot would be to a more expanding monetary policy. That's what they mean by pivot. Again, when inflation's high, they want to contract it because inflation's high. So their whole job of raising rates is to make the market, is to make prices go down, contract, if you will. And so, if he pivots to a expanding monetary policy, that'll show optimism in terms of inflation. I don't know if it's the wise move, but I think he's getting a lot of pressure to do so. And again, let me know what you guys think. So far, we did on par with expectations, 75 basis points. Market initially reacted positively here. The rate hike decision is already there, Nicholas. If you want to actually read the press conference, it's right here. Or if you want to read the actual report, it's right here. You can watch Jay Powell right here. We're going to cover the stream as soon as it goes live. Again, you'll be able to watch it right here. So we will stream the actual full press conference. Yeah, 75 basis points is what we did. Again, 75 basis points flavor. A nice king. Conference is at 2:30. Again, markets responding positive. Dollar index is falling down. All right, we're at 375, initially reacting positive. Again, we're kind of consolidating right now. Again, we got about 20 minutes, guys. 20 minutes before the Jerome Powell press conference starts. We're at 387.30s right now, 387.30s. Consolidating after the rate hike decision. We came in at expectation, 75 basis points. And so with that, we responded positively. The question is now, what does Jerome Powell sound like during the actual press conference, which again will go live at 2:30 in 20 minutes. We will stream the entire thing live. You'll be able to watch the entire thing right here. And again, we'll see what we get. Again, the press conference will go live. All right, we're starting to pull back a little bit. We're at 386. Again, we did do as expected. We did show as expected. 75 basis point rate hike decision, as expected. Again, y'all stick around. We will be streaming the full thing. SPY at 386. Again, if you want to help support the channel, check out TopStep. TopStep is a funded account program for futures. They are a sponsor of our video. They give you a demo, and if you can hit their target on the demo while following their rules, they fund you. One of the ways you can trade these big things without needing PDT, like a 25K plus in the stock market, is you can trade the E-mini. Here's the E-mini on the left. You can trade that in the futures market. You can see it's the same thing as the SPY, but there's no PDT restrictions, so you can day trade in short. TopStep is a funded account program in the futures market. They give you a demo. If you can hit their targets and pass their phases, then they'll fund you between 50 up to 150K with a 90% split. They are regulated by the U.S. Chicago Mercantile Exchange. They pay out millions, fund thousands of traders a year. They're the most legitimate funded account program in the world. Although I am certainly biased because they are a sponsor of mine as well, so I'm certainly biased in their favor. If you want to check them out, here's the link. Great way to help support the channel. We'll post that link in chat. Again, we'll Jerome Powell, we're going to pin it to the top of the chat if you want to check it out as well. Again, we're starting to pull back a little bit. SPY's at 386s. And so again, the question is, will we hold over this previous closing price? Technically, we were red on the day when they made this announcement. You can see from this announcement, we actually moved all the way up over it. And now we are technically green on the day. We are over, again, that previous closing price level that we spoke about numerous times. And so again, the question is, do we hold over this level? Will we retain our green on the day in the broader markets? And, if we do, what does the next few days look like? Again, it's all going to be relative to what Jerome Powell states during this Fed meeting, which is, again, in 18 minutes. And hopefully he says some, good things about the market and not some bearish things. Yeah, the Bank of England interest rate decision is tomorrow morning. We're going to be covering that as well. So again, stick around. We will stream, that as well if we need to. 75 basis points is bad, right? Well, conventionally it is, but it's relative to expectations. So it all depends on how good or bad expectations were. Again, a lot of the stock market, to understand it, is all based off of expectational numbers. Okay, so we can look at conventional numbers, and in that case, 75 basis points is very aggressive, which is a lot of the time seen as bad. But it's all relative to expectations. For earnings, a company can lose $100 million, but if they expected to lose $200 or $300 million, the stock is probably going to go up still. And so, in that degree, in that regard, we can look at this and say, okay, they were expecting 75 basis points. It's going business as expected, and the plan is going according accordingly here, and thus we get a bullish response. Now, at the same time, though, we're still very, 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 very early. This doesn't mean anything yet. This is a slight green move. We're technically green right now, but what's really about to happen is during this press conference in 17 minutes, everybody is going to analyze Jerome Powell's tone and his words and how optimistic he is sounding about the current inflationary market, or the current inflationary prices and pressure. And so that's what the real influence is going to be today, is Jerome Powell's press conference, which is, again, in about 16 minutes. We'll stream it all live. Yeah, Joe, you just seem toxic, bro. My guy is just insecure over there, calls it a mess. Just looking for somebody to yell out, bro. Let it out, Joe. Hey, listen, let it out, man. I'm sorry. You got whatever you got going on. Cheers to you, bro. Let it out. SPY going up. It's at 387s right now. We got the press conference in 16 minutes, guys. We'll see what happens. Yeah, Jerome's gonna walk in singing songs. Any requests, let us know. E-mini up to 38.90s here, 38.90s. Yeah, he was definitely a frustrated bear. He was really mad about Snapchat at like 8s, and now Snapchat's at 10s. He's pretty quiet about that pick I made, huh? My guy's over there just upset, dude. Everyone get frustrated, maybe. Yeah. No, not you, Joe. Different Joe. My bad, bro. Not you. Completely different Joe. You're good, dude. Is he going to show the projection in the start of the meeting or what? Basically, he's going to give updates on what to expect for the next Fed meeting. I mean, again, this is fundamental. Like what Jerome Powell says during this press conference is fundamental for sure. That's what's going to matter a lot, is how optimistic he is regarding the next rate hike decision. That's what's going to influence price action over the next 6 weeks leading into the mid to late December Fed meeting as well. Everybody's going to try to speculate on what he's going to raise in terms of rate hikes, like how much it's going to be. And they're going to use that to get into trades and get out to trades. It's certainly going to influence markets. And so that's kind of why people pay attention to this. 75 was always, everybody expected 75. We were talking about this morning. Yeah, hawkish is aggressive, contracting monetary policy. Dovish is expanding monetary policy and less aggressive rate hikes. Hey, thank you, Ken. I appreciate you, brother. Thank you, man. Yeah, we could drop after the meeting. That's certainly possible. I mean, you guys know me. I really don't try to predict anything. Yeah, I saw that, Eddie. It'll be interesting to see how we respond here. We're consolidating right now. But again, last time we moved up a little bit and then we dropped for the next 3 days. And so, again, it doesn't really matter what we're getting right now. It depends on what happens over the next couple of days and really how Jerome Powell, again, watch. Like you always see. Okay, like we're going to do this Jerome Powell press conference. Right now, we're kind of consolidating sideways. So we're not really moving too much right now. We're mostly just moving sideways. What's really going to be interesting is how we start moving once this press conference starts. And again, it starts in 13 minutes. Hey, thank you, JD. Yeah, I try not to predict anything, Hey, thank you, Adam. I appreciate you, bro. Thank you, man. Are you trading this meeting? I don't know. Probably not. I mean, there's just too much risk. I mean, people romanticize volatility like that, but there's low edge doing so. I trade with the trend. It's very hard to predict the trend whenever he's saying something different every 3 minutes. You know what I mean? Market will pop and drop and just go crazy. I'm not really trying to jump in that. That just seems like picking up pennies in front of a train. Yeah, it's possible it dumps. It's possible we go either way here. It depends on what he says. Hawkish or dovish? I have no idea. Really have no idea. Yeah, Philippe, that doesn't sound like a bad idea. How was Halloween with the family? It was good, man. Jack was Steve. I was Daemon Targaryen. And then my daughter was Daphne. Carol wasn't anything. I think Carol was a concert goer, is what she said she was. So yeah, it was fun. All right, guys, we got 11 minutes. 11 minutes. Y'all be ready. Starting to kind of slightly trend down here. 75 basis point was the rate hike decision. Cool answer. I try, man. You know, coolest traders in the world right now. You know, does the outcome of a speech happen instantly? What outcome? We already know the rate hike. It's 75 basis points. It's 4%, 75 basis points. You know, like we already know what the decision is. Right now, he's going to comment on that decision, and so. Give an example of what he can say in the effect of your example. He can say, a lot of us at the Fed fear that inflation is going to go on for a really long time, you know, until 2024 and beyond that. And so we're going to have to aggressively raise rates each 6 weeks for the next year, you know. Or he could, that would cause the market to obviously drop. He could say, hey, you know, we're noticing good, and, you know, we're noticing that we're impacting inflation in a great way with these aggressive rate hikes. And so we might be able to ease back on our rate hikes aggression moving forward. You know, boom, market goes up. You could say whatever. That is how it's going to influence markets. Again, they pay attention to these Fed meetings to get an influence on, to judge the influence on the rate hike and what the next rate hike decision will be. Yeah, all good. Fast, cosmic. It moves fast with it. You'll be able to see it. Again, I'm not trading it. What do you think of PayPal earnings? I don't know. I don't really like PayPal as a company. No offense to PayPal. I just think that crypto replaces PayPal. So they've got a pretty rough looking chart. Market's starting to move up a little bit. Here's the dollar index on the left. Again, 9 minutes, team, 9 minutes. Will Papa Powell come dancing? You know, maybe. All right, guys, dollar index at 110s. We got the SPY at 386s. Again, at 110.80s on the dollar index. SPY still sideways. Is 75 points a good thing or is it too much? It's such a subjective interpretation, you know. Again, conventionally it's high and aggressive, and that's bad. But it's what they expected. So it's kind of like, it's not great, but it's what they were expecting. And so it's better than having something worse than expected show up, like 100, you know, and that's even arguable as well. Some people think 100 would be better right now, and understandably so. It might do more to combat inflation long term, but it is going to cause short term pain if it was. And so that's why we're waiting to see what he says, to see if we can figure out what he's going to do for the next Fed meeting, because he'll usually give some type of foresight or foreshadowing into what they might do during the next one. The next one will be mid to late December. Yeah, exactly. H. Scott. Hey, thank you, External. I appreciate it, man. Thank you. $2,500 for misinformation. What charting software do you use? I use Chart Prime. Is what I've been using lately. They're a sponsor of my video right now, but the reason I even allowed sponsorship from them is because I actually use them. You know, if you look at this, like here's the SPY. You know, or here's the E-mini is what I like using it on. And it's a trading view indicator. It's pretty accurate, man. Like, look at this. So possible reversal down, drop, possible reversal up, bounce, possible reversal down, drop. It's a premium indicator service. It'll also look at like candlesticks, like bullish hammer candlestick. Look at the follow through bounce here. Possible reversal up. This one was wrong. But again, you can see these bullish engulfing. We get some bounces, possible reversal up. We get a little bit of follow through bounces, bullish engulfing, and I got to spread this out to make it actually, so you can actually see how well it was. Look, bullish engulfing, bounces, possible reversal down. That one might have been wrong, but look at this green signal. We get a nice bounce over the next couple minutes. So just pretty useful. It also automatically documents support or resistance. But again, I love using it specifically for candlestick identifiers, because these things can be super accurate in predicting tops and bottoms, bearish engulfing, especially the bear ones. Follow through drop, bearish engulfing drop, bullish engulfing bounce, and you can keep using them. If you want to check it out, you can find the link to that in the description. Market's starting to pop up a little bit. We are starting to get some upward movement here from that. But yeah, they are a sponsor of mine, so like I always say, I'm certainly biased in their favor. But it's a trading view indicator service, so you can use it on stocks, future, crypto, whatever you want to use it on, really. Bitcoin, ETH, whatever you want to use it. SPY moving up though. So again, we have 6 minutes. 6 minutes. I have no idea where euro, US dollar, forex will go. Inflation will only cure if there's a little hype, but causing extreme fears is bad. Investors pull their money out, but how could they think the company will grow without any money coming in? Yeah. Most indexes spiked up immediate at the expected 75 basis point. Why didn't it just freeze where it was? Well, because most markets are influenced by this. It probably trickles down to one at first, and then they'll see how one of the big index funds or funds are doing, and then when they react positively, everything else kind of snowballs from there and copies off of it, and people start jumping in on the long side, and that pushes it up more. And but in the grand scheme of things, this is a pretty solid upward move, but it's not huge. We really don't know what the impact of the Fed rate hike decision is going to be yet. Not yet. Again, we still got a couple days before we really see how this is truly going to impact things. We went from red to green on the day on the market, on the SPY or the S&P, but it doesn't quite mean much yet. It's not really up enough to really have any big vote of confidence in any direction right now. Depends on what he says. There'll be a Q&A at the end probably. All right, team. Again, we are sitting here waiting for the press conference to start. We will stream the entire thing live, so y'all stick around. All right, guys, remember, we got 3 minutes, team. 3 minutes. We're sitting in the hold room now for the press conference. It should start anytime. Again, subscribe if you haven't already. Hit the notification bell. We appreciate it. No, man, I wouldn't want Powell's job. That's a hard job. Yeah, we're going to cover it, TCE. We cover all the major stuff, dude. We cover, CPI, PPI, GDP, jobless claims. We'll cover the Bank of England rate hike tomorrow. There's also a bunch of other stuff tomorrow as well. If we look at what we got going on tomorrow, and again, y'all subscribe. We'll cover it all. Tomorrow we have ECB speaking. There's some stuff going on there. There's the composite PMI, services PMI in England, house price index. We got the European unemployment rate. Expectations are for 6.6%. We got challenger job cuts here in the U.S. Bank of England, interest rate decision, import-export prices in the U.S., initial jobless claims in the U.S., non-farm productivity, quarter-over-quarter trade balance, and unit labor costs as well tomorrow, as well as Canadian import-exports. We'll cover all this stuff, to be honest. S&P Global Composite PMI for October is coming out as well. Services PMI are also coming out tomorrow. So, again, a lot of stuff happening tomorrow. A lot of different stuff. It's going to be tomorrow morning, though. And so, again, we will be streaming then as well, bright and early. We start streaming very early in the morning. And so, hey, hit that sub button, and we'll see you guys then. Any good books on the Federal Reserve? Not that I know of. Again, the basic way the Federal Reserve works is that they raise or lower rates depending on how bad inflation is. If inflation's really bad, they raise rates aggressively. It causes more short-term pain, but their job is to discourage spending so that prices drop. Because when interest rates are high, people stop spending. When people stop spending, companies must in turn lower pricing in order to remain competitive. And so the way the Fed controls interest rates and in turn inflation is by raising or lowering them. And so again, that happens every 6 weeks. The Fed will make their rate hike decision, and then they do a press conference at 2:30. We also have once a month multiple inflation gauges that drop, specifically CPI, PPI, and PCE. Those are all different sides of the inflation metric that we pay attention to. A lot of the time, the Fed uses PPI and PCE data to judge how bad inflation is. And those drop usually once a month. You can also use job numbers that are influencing things as well, like how much people are working, because the more people that are working, the more people that are working, the more people that have money. And when people have lots of money, what do? They spend. When people spend, prices go up, inflation gets bad. And so it's kind of backwards land right now where, every time we get these unemployment numbers, if unemployment is higher than expected, the market will actually go down because they're like, oh no, people have money and they're spending it. And so that's bad, obviously, for inflation, but it's just a weird dynamic, weird nuance behind everything right now. SPY's actually moving up. It's at 388. The actual press conference starts right now. So again, let's get ready. Waiting for it to start. Y'all can hear the music, correct? I just turned it off. Again, we're waiting for this to start. Jerome Powell should start any minute, guys. All right. Yeah, we broke 90K. Thank you. Thank you so much. We appreciate it. We're getting there. Hey, nice, Tiny. Oh, no, not nice. I'm sorry. I read your comment. I had to reread it. My bad. Oh, that definitely caused it. 2020 caused it. A lot of things caused it, to be completely honest. At a certain point, people weren't spending enough, and then it got crazy. And then, all right, here we go. Let's make sure the mic is working. Sound check. Y'all can hear everything, correct?
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance. with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple of things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement because that really does become the important question we think now is how far to go. And I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming. And it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this. And as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa, the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view, but I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah. So the way I would think about that is, it's a commonly for a long time thought that monetary policy works with long and variable lags, and that it works first on financial conditions, and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking, what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive. And we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting, a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah. So, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very carefully, much more carefully managed by the lenders. So it's a very different situation and doesn't present doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Subscribe, guys. Free content.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers. And I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening, and maybe that's there, but it's not. It's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see, we would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but, not by as much as we thought the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the US that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but, we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas. And they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer term inflation expectations anchored and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Oh, no.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust. And we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. And we've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens. So there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted, and also you have to look at why why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing you didn't actually get it. You have to go back in. By then, the risk really is that it has become entrenched in people's thinking. And the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now. And I think as we're farther along, we're now focused on that. What's the level we need to get to rates. And I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up in, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming. Okay. But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and, that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So those I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects. Although I think overall, I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data is a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems hadn't resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
All right, guys. So that is the press conference from Jerome Powell. Initially, we've had somewhat of a mixed response here. We're mostly bearish from the response. You can see the actual Fed announcement came out right here. So we are slightly down relative to, where we were prior to the rate hike decision, which again was 75 basis points. We are slightly red relative to that decision. You can see, it came out around here, and we've slowly kind of moved down since then. Initially reacted positively. Again, the real question for this will be, how does the market respond moving forward? In the next 2 weeks, we do have CPI, which is consumer inflation reading. That is probably one of the biggest influential data releases we have in the next month, is the CPI reading somewhere around November 12th and November 13th. Tomorrow, guys, we also have a lot of stuff dropping. And again, we will be streaming all of this. So tomorrow we have the Bank of England rate hike decision. So basically England's version of today. We have European unemployment rate. We got challenger job cuts coming out tomorrow. We have like I said, Bank of England interest rate decision, continuing jobless claims in the U.S., import-export prices, jobless claims initially, non-farm productivity, trade balance, unit costs, import-export prices in Canada, and a lot more stuff dropping. Services PMI at 9:45 tomorrow. A lot of influential stuff is happening tomorrow, guys. So y'all be ready. We'll be back bright and early. We will stream live. We are going to be doing a crypto show today as well, guys. So we're going to end the stream, and we're immediately going to go to our crypto channel for a crypto stream where we're going to talk about Twitter running up on running Dogecoin up, PayPal, potentially joining crypto, and a lot of other stuff to talk about on our crypto show. You won't have to go anywhere as long as you're on a PC. As soon as we close down the stream, it should immediately bring you to the crypto channel. If it doesn't, here is the link for the crypto channel. There's the link in chat. It's youtube.com/beginner crypto. Again, check out our sponsors. Check out Top Step if you want to get around the PDT rule. If you look at the futures contract, the E-mini, on the left, you can see it's the same exact price action as the S&P 500 or the SPY, and you can day trade futures with no PDT restrictions. Top Step is the most legitimate prop firm / funded account program in the world. They fund thousands of traders, pay out millions of dollars in withdrawals every year. If you want to check them out, you can get 20% off. They are a sponsor of my video. There is the link. And with that said, we're going to start our crypto show right now. So we'll see you guys over there. Good luck. Again, youtube.com/beginner crypto is where we're going to be heading after this stream. To hold a crypto show. And so again, youtube.com/beginner crypto. We'll see you guys over there. And yeah, we're going to close down the live stream now. So we'll see you guys over there.